Well, thanks for having me comment on federal budget changes. And we're going to look today specifically at two very significant federal budget changes to life insurance planning. Now, what's quite interesting about this 2015 federal budget, it was released on March 21st by Jim Flaherty, was that they didn't proceed with what they had warned us they would do, which is adjusting what is called the MTAR Rules. The MTAR Rules are the rules that define how much investments we can warehouse within a universal life policy and have those investments grow on a tax-sheltered basis. So the MTAR rules are very broad-based and far-reaching rules on the use of life insurance for investing purposes. We were warned over the last 2 years and in the 2012 budget that they were going to be changing these MTAR rules. They even gave us specific ideas on what they were going to be doing, and it did not happen. So this made a number of tax planners quite relieved, but what was written into the 2013 budget is a promise that in the coming months they will be addressing and adjusting the MTAR rules. So insurance tax planners will continue to wait with bated breath on that. Two changes in this federal budget, the most severe and significant, are a direct addressing of what are called the 10-8 strategies. Now, the 10-8 strategy is something that's not even 10 years old, but has had just enormous support in the insurance tax planning community, and a fairly vigorous response by Canada Revenue Agency, who fairly unsuccessfully has been trying to attack the use of this strategy under the current legislation, and so they were unsuccessful with that. So here we are in the 2013 budget. Finance has just adjusted the legislation to disallow 10-8 programs. Now, in a 10-8 program, this is where a taxpayer will borrow funds from a financial institution using investments in an insurance policy as collateral on that loan. Now, when these transactions are put together, what's been happening is the loan is charged out at 10%, and the investments that are used as collateral in the insurance policy are guaranteed by that provider to earn the taxpayer 8%. Now, the 8% is growing tax-sheltered in the life policy, and the loan that's being charged out at 10% gains interest deductibility. When you flow the transaction through from a tax standpoint, the 10% that's deductible ends up costing a net of about 6 in most provinces. And so you have a risk-free spread of about 2%, the 8 tax-sheltered and the 6 after-tax cost. And then in addition to this, many of the strategies use life insurance premium deductibility rules and gained a partial deduction on the insurance policy premiums called the NCPI. So this really picked up a fair bit of steam in the last 10 years. A number of insurance companies have really driven forward with this strategy. The budget comes in, and now what the budget says through the new legislation is that where a loan has been arranged with terms of the loan tied to a life insurance policy, and those two transactions are tied together with the policy being pledged as collateral in the loan, they're going to disallow all of the tax benefits I've just mentioned. The interest deductibility is gone, the deduction of the NCPI is gone, and the ability on death to have the insurance proceeds paid to a small business and credit the capital dividend account is gone. Now, what's significant about this is not only does this end the ability to do a 10-8 strategy, but they are not grandfathering. So anybody that's currently in a 10-8 strategy is being offered some special transition opportunities during the 2013 tax year to get out of the 10-8 strategy. This is going to cause a lot of work for tax planners that have been doing 10-8s because they have effectively the rest of 2013 to get the clients out. And unfortunately, insurance products are going to have to be looked at quite closely by the insurance companies because you can't just necessarily draw investments out without fees and charges as well. In addition to that, CRA says, look, anybody that comes up with creative ways to get around these new rules, we're going to address that aggressively and retroactively. So this is really headline news, probably one of the biggest, I believe, changes in the federal budget for at least the insurance industry, if not many Canadians, and it's going to create some interesting work throughout the rest of 2013 for insurance planners. Now, slightly less severe is the other big change in the federal budget, which is the ending of the triple back-to-backs, the levered insured annuities. In this instance, The proceeds of a bank loan are used to purchase an annuity, and the annuity income is used to fund a life insurance policy. So there's 3 products that are tied together. That's why they call it the triple back-to-back. Now, these have been used for a good 20 years in Canada, often by small business owners. And in this strategy, like the 10-8, we're gaining tax deductibility on the loan interest. We're getting partial deductibility on the insurance premiums called the NCPI. And money within the insurance policy grows tax sheltered and credits the CDA account of the small business on death. So now, under these new rules, thanks to the 2013 budget, the triple back-to-backs are effectively dead. They will not allow interest deductibility, NCPI deductions, or CDA credits if a triple back-to-back is put into place. And they are offering this on a go-forward basis. So they're allowing grandfathering of any triple back-to-backs to this point in time. So those are the big changes. The 10-8s and the triple back-to-backs look like they are now effectively terminated as far as the tax planning tool in Canada. Something certainly that you'll want to watch for more information on as the impact of these changes unravel. And for now, my name is Ian Quigley. I'm from Qube Investment Management, and you can follow us at qubeconsulting.ca or on Twitter at QubeTips. That's all one word.